Over the past 3 decades, Poland has undergone one of the most dramatic economic transformations in modern history. As soon as it was freed from communist central planning, it emerged as a fast-growing, export-driven success story. But while it has enthusiastically seized the opportunities of a mixed capitalist economy, it's now facing a new and more complex challenge. You see, what now lies ahead for Poland isn't about copying others. It's about creating something original. And that's potentially going to be more difficult. If you were to go back just a few decades, Poland looked nothing like the ambitious European economy it is today. In the late 1980s, the country was still under communist rule. The economy was centrally planned, inefficient, and stagnating. Shops were empty, queues stretched for hours. Inflation was spiraling. By 1989, Poland was on the brink of economic collapse. But then came a radical shift. Poland became the first country in the Eastern Bloc to break with communism. And what followed is now known as the shock therapy period, a painful but dramatic shift to capitalism. Prices were liberalised, state-owned firms were privatised, foreign trade was opened up almost overnight. The early years were chaotic. In early 1990, nearly all price controls were scrapped. Overnight, goods that had been perpetually scarce under communism appeared on store shelves, but now at prices determined by the market. Consumers were shocked. Prices soared, inflation spiked dramatically, peaking at nearly 600% that year. Unemployment, which had been banned under communism, appeared for the first time. But also for the first time in decades, growth became a possibility. Throughout the 1990s and early 2000s, Poland rebuilt its economy from the ground up. Private businesses flourished, exports rose. And as the country moved closer to the European Union, investment began pouring in. When Poland finally joined the EU in 2004, it gained access to a massive single market and billions in structural funds. Roads were paved, airports were modernised, the railways were upgraded. For many Poles, life improved dramatically within a decade. But what really powered Poland's rise was its role in the wider European economy. It became what economists call a low-cost, high-skill manufacturing hub. Wages were far lower than in Germany or France, but the workforce was well-educated and disciplined. Multinational firms noticed, and German car makers, French appliance companies, and Swedish furniture giants all began building factories in Poland or outsourcing components to be manufactured there. This export-led model worked wonders. Poland became the EU's 6th largest economy. It avoided the worst effects of the 2008 global financial crisis. And over the years, growth was steady. Real incomes rose. A large Polish middle class emerged, and by around 2015, it seemed Poland was on an unstoppable path toward prosperity. But now, 10 years later, in 2025, things aren't so simple. The headline numbers still look okay. Growth has returned after a sluggish 2023. Inflation has come down, and unemployment is low. But underneath the surface, the economy is starting to show signs of strain. And one of the biggest problems is that Poland appears to be stuck in what economists call the middle-income trap. This happens when a country grows fast in the early stages, by moving farm hands into factories, by attracting foreign capital, by exporting cheap goods, but then hits a wall. Wages rise, costs go up. You're no longer cheap enough to compete with countries like Vietnam or India, but not innovative or productive enough to compete with Germany or South Korea either. Poland is reaching that point. Wages have risen, and rightly so. That was the intention. But productivity hasn't kept up. The low-cost manufacturing model that fueled growth for 20 years is no longer enough. To break through, Poland needs to become a high-income, high-productivity economy. That means more innovation, better infrastructure, stronger institutions, and massive investment in education and research. But this is very hard to achieve, because unlike early-stage growth, which is often about copying what works elsewhere, the leap to high-income status requires original thinking, coordination, and trust in institutions. And right now, Poland is struggling on those fronts. Another problem is demographics. Poland's population is shrinking and aging. Many young Poles have left for better pay abroad. At the same time, the country has one of the lowest birth rates in Europe. Employers are already reporting worker shortages in sectors like logistics, construction, and healthcare. The government has resisted large-scale immigration, but without new workers, growth will be harder to sustain. There's also the issue of defense. Since Russia's second invasion of Ukraine in 2022, Poland has massively ramped up military spending. It now spends more than 4.5% of GDP on defense, the highest in NATO. While some of that money goes to useful upgrades and deterrence, critics say too much is being funneled into state-run arms manufacturers that are inefficient and poorly managed. With public debt rising, some economists worry that defense spending is crowding out investment in other critical areas, like private sector innovation, as well as education and infrastructure. Political instability hasn't helped either. After years of rule by the Nationalist Law and Justice Party, a centrist coalition led by Donald Tusk returned to power in late 2023. Markets welcomed the change, but deep institutional conflicts remain. Tusk controls the government, but not the presidency. Courts and state media are still stacked with political appointees from the previous regime. Reforms, including those needed to unlock billions in EU funds, are stuck in legal limbo. And that gridlock has discouraged both domestic and foreign investment. To make matters worse, global trade tensions are returning. Trump's tariffs include a 25% tax on cars. That might sound like a problem for Germany, not Poland, but Poland exports huge quantities of components to German car makers. If fewer German cars are sold in America, demand for Polish parts falls too. Estimates suggest this could knock up to 0.5% off Polish GDP. So what is the outlook? Poland is still growing. It's still relatively stable, and it still has enormous potential. It has a large, educated population. It's geographically well placed. It's deeply integrated into European supply chains. And it's shown again and again that it can adapt when it has to. But it looks like the easy years are over. The transition from communism is complete. The low-cost boom is behind us, and what lies ahead looks much harder. Poland must follow a new model with original ideas. It must move up the value chain. It must become not just a place that builds other people's ideas, but one that creates its own. That means investing in research, in digital infrastructure, in high-end manufacturing, and in human capital. Poland is taking meaningful steps. The government has launched ambitious initiatives to fund cutting-edge technologies, including a €232 million national AI strategy aimed at building Poland's own large language models and applying artificial intelligence across sectors like energy, logistics, and healthcare. The National Centre for Research and Development is backing international R&D partnerships, especially with Swiss and EU institutions, to help Polish firms innovate beyond their borders. In digital infrastructure, Poland has committed billions to expand high-speed broadband, build secure cloud systems, and modernize public services. Tech giants like Microsoft and Google are investing heavily in upskilling the Polish workforce, with programs to train over 1 million young people in digital and cybersecurity skills. And Intel is building a multi-billion euro semiconductor facility near Wrocław, one of the largest foreign investments in Polish history. These are exactly the kinds of value-added industries Poland needs to move up the supply chain, but its overall R&D spending level remains low. Poland spends just 1.4% of GDP on R&D. That's well below the EU average of around 2.3% and far below leaders like Germany or South Korea on around 3 and 5%. Poland's leaders must urgently address this. Because unless there is a dramatic increase in development, innovation will remain shallow, and Poland could very easily become stuck at middle income levels, just as Malaysia, Thailand, Mexico, Argentina, and many others have done in the past. And that would be a terrible mistake. A link to the next video should be on your screens now. Just click to keep watching. I hope you enjoyed this video. If you did, then please like, subscribe, and comment. Thanks for watching.